Welcome back to Health Insurance Doesn't Have to Suck. I'm Brian Calvert. Over the last 5 episodes, we've built a real foundation. We've talked about why health insurance feels so confusing in the first place. We've covered the 5 terms that make up every plan. We've looked at why premiums go up, why deductibles have exploded, and last episode we got into pharmacy costs, what's driving them, and what you can actually do about them. Today we're going to pull it all together because understanding how health insurance works is one thing, but actually sitting down in front of a plan comparison and making a decision, well, that's a different challenge. And it's one most people face alone without a lot of guidance. So today I'm going to give you a practical framework for how to choose a plan, not in theory, but in practice. And we're going to walk through a few real scenarios so you can find yourself, if you find yourself in one of them, and you can walk away knowing what you actually do. At the end, I want to mention something for small business owners listening as well, because your decision is a different one and it deserves its own conversation, and that's coming in a future episode. But first, let's talk about how to actually choose a plan. Most people approach plan selection the wrong way. They open a comparison or a spreadsheet, they look at the premiums, and they start from there. The problem is that the premium is just the output. It's the result of everything that's underneath the plan. So if you start there, you're choosing based on one number without understanding what the number represents often. So before you look at a single plan, you need to answer 4 questions about yourself. Your answers are going to drive everything else. So question 1, how do I actually use healthcare? So be honest here. Are you someone who rarely goes to the doctor? Maybe 1 visit a year, maybe none. Or do you have regular visits, ongoing care, specialists you see consistently? This matters more than almost anything else in your decision. Question 2, do I take any regular medications? If yes, you already know from the last episode. Check your formulary on the plan you're considering. Know what tier your medications sit on before you commit to a plan. This can be significant cost difference that doesn't show up in the premium. Question 3, what is my financing cushion if something goes wrong? This is an honest question most people skip. If you had a $4,000 medical bill tomorrow, could you handle it? Not comfortably, but just handle it. Because if the answer is no, a high deductible plan carries real financial risk for you, regardless of how attractive the premium looks. And question 4, is anything changing this year? Are you planning a surgery, expecting a baby, managing a new diagnosis, or maybe starting a new medication? Any of these change your math significantly. A plan that made sense last year may not be the right one for this year. So once you've answered those questions, you need to understand what you're actually comparing. And at the core, most plan decisions come down to one fundamental trade-off, the same one we've talked about since episode 1. How much risk are you going to keep, and how much are you going to transfer? So if you go with a lower premium, you keep more risk. If something happens, you may pay more out of pocket because the insurance company doesn't start sharing the cost till a much higher number. A higher premium, if you transfer more risk, if something happens, the insurance company steps in sooner, but you're paying for that protection every month whether you use it or not. So there's no universally right answer. The right answer depends entirely on your situation, which is exactly why those 4 questions matter. And then beyond premium and deductible, there are a few other things that are worth looking at on any plan. The max out of pocket, right? This is your ceiling, the most you'd ever pay in a calendar year before the insurance company covers 100%. Know this number on any plan you're considering. It's your worst case scenario. The network. Are your doctors in network? Is your preferred hospital covered? Any out-of-network bill can be significant, and it's worth a quick check before you commit. And then the copays. We've talked about them before. For primary care or a specialist or an urgent care or even the ER. If you use these regularly, the difference between plans can add up quickly over the course of the year. Now let me show you how this actually plays out, because the same plan is using it. So I want to walk you through 3 situations. As I go through these, I want you to find the one that's closest to yours. Okay. Let's say scenario 1. Let's say you're in your late 20s or early 30s and you're genuinely healthy. You go to the doctor maybe once a year. You don't take any regular medications. You have a reasonable financial cushion. Not a lot, but enough to handle a few $1,000s if something unexpected came up. For this person, a high deductible plan often makes a lot of sense, and here's why. The premium savings are real, and month after month, if you're not using the plan, those savings accumulate. The deductible is high, but statistically, A healthy person in this situation is unlikely to hit it most years. And critically, this is a person who should absolutely be pairing their high deductible plan with an HSA. Those premium savings, put them in the HSA, let them grow tax-free. Over time, that becomes a meaningful financial cushion specifically for healthcare costs. And you're not just saving on premiums, you're building an asset. All right, so let's talk about options. Scenario 2, scenario B. Now let's say you have a family, 2 adults, 2 kids, they get sick. They go to the doctor, they need occasional urgent care. Nothing serious, but there's regular utilization throughout the year. Maybe one of the adults sees a specialist periodically. This family needs to think about this differently, right? First, with a family plan, remember there are 2 deductibles to think about, the individual deductible and the family deductible. If multiple family members are hitting their individual deductibles, the total out-of-pocket exposure can be significant with a high deductible plan. And second, copays matter more here. If you're making 10 or 15 doctor visits a year across the family, the difference between a $25 copay and a $50 copay is real money over 12 months. For a family with regular utilization, a lower deductible plan with higher premiums often ends up making more financial sense when you run the full math, not just the monthly cost, but the total cost of care over the year. The premium feels higher, but the predictability has real value. And now, scenario 3 or C. Now let's say you have a chronic condition, diabetes and an autoimmune disorder, heart disease, anything that means you need regular visits, ongoing prescriptions, and the possibility of procedures or hospitalizations in a given year. This is a situation where a plan selection becomes the most consequential and where most people need a clear framework. For this person, the max out-of-pocket is arguably the most important number in the plan. If there's a real chance you're going to hit your deductible and move into the coinsurance territory every year, you want to know exactly where that ceiling is. Because once you hit the max out-of-pocket, the insurance company pays 100%. So for someone with significant ongoing care that needs protection, this has real value. The formulary check is also non-negotiable here. Know exactly what tier your medication sits on across any plan you're considering. A specialty medication that's covered at 20% coinsurance on one plan might be tier 5 with a flat cost share on another, and that difference can be thousands of dollars annually. For this person, a lower deductible plan with a lower max out-of-pocket is often worth the higher premium because the financial protection is real and the likelihood of needing it is real. So let me give you a simple way to compare plans that most people don't use. Instead of just looking at the monthly premium, build 2 numbers for each plan you're considering. The first number, your best case annual cost. That's 12 months of premiums, assuming you barely use the plan. Just your premium times 12 plus a copay for routine visits you know you'll have. The second number, your worst case annual cost. That's 12 months of premiums plus your full max out of pocket. This is what you'd pay if something significant happened. Now look at both numbers across the plans you're comparing. Sometimes the plan with a lower premium has a worst case that's actually higher than the plan with the higher premium because the max out of pocket is so much larger. And that's the kind of thing that doesn't show up when you're just looking at a monthly number. And that's not a perfect analysis. Real life lands somewhere in the middle, of course, but it gives you a range, and the range is what matters. If you're a small business owner, by the way, listening to this, you've probably been nodding along and also thinking that your situation is more complicated than any of these scenarios. You're right, it is. You're not just choosing a plan for yourself, you're choosing a plan or a set of plans for your entire team. And the considerations are different. Contribution strategy, plan design, how to balance costs for the business against values for the employees, whether a fully insured plan makes sense or whether it's time to look at alternative funding structures. That conversation deserves its own episode, and it's coming. And we're going to dedicate a full episode specifically to how small business owners should think about health benefits, the decision, the options, the framework, and making it all make sense for your business and your people. So if that's you, stay with us. That one's for you. So let me bring this together, though. Choosing a plan isn't about finding the cheapest option. It's about finding the right match between your situation and a plan structure. That starts with 4 honest questions about how you use healthcare, what your financial cushion looks like, and whether anything is changing this year. And then it comes down to the trade-off we've talked about from the very beginning. How much risk you're keeping versus how much you're transferring. And the math isn't just the monthly premium, it's the best case and worst case scenarios across the full year. A healthy individual managing a chronic condition can make the exact same plan completely different and completely correct decisions. because the right plan isn't universal, it's personal. So in the next episode, we're going to start going deeper on the employer side, how employers think about health benefits, what drives their decisions, what that means for you as an employee. It's a perspective that changes how you see your own plan, to be honest. So if you found this helpful, please follow the show and share it with someone heading into the open enrollment who could use a clear framework. I also write a companion newsletter called Clarity Notes that goes deeper on what we cover each week. I'm Brian Calvert. Thanks for being here, and we'll keep building clarity from here.